about measuring the cost of credit and how to obtain credit. So your debt payments to income ratio is what lenders typically look at first, and that's your percentage of debt in relation to your net income. Your net income is your take-home pay. Experts suggest that you shouldn't have any more than 20% of your net income being spent on debt payments, so your total monthly debt payments are being divided by your monthly income to figure out that ratio. Your finance charges and annual percentage rates. We've talked about how you have a fee that you have to pay in order to use credit, and that's what an APR is. So it's showing you how much credit costs you on a yearly basis, and it's expressed as a percentage. As an example here, we have an APR of 18%, and that means that you pay $18 on every $100 you owe each year. Your long-term financing, if you use long-term financing, you get smaller monthly payments, but this typically means that you're going to pay more interest in the long run over the course of the loan. With your interest rates, you have variable interest rates, secured loans, upfront cash, and short-term. Your variable interest rate means that your rates change in the banking system. For a secure loan, the second one, it may be lower interest rate, but they might ask for some kind of collateral. So, for example, a car or your house, those kind of things. And then you have upfront cash, which would be large down payment. There's a larger stake to repay. And then your last one down here at the bottom, the short term. The shorter the term, the better chance for you to repay higher monthly payments, and then they have lower risk to the lender. Calculating your cost of interest, you have simple interest, so it's interest compounded only on the principal. So you have the principal times the interest rate times the amount borrowed, or the amount of time borrowed, excuse me. And simple interest, you have a declining balance you pay on principal that has not been repaid, and more often your payments are made, the lower your interest is going to be paid. And then add-on interest is interest calculated on full amount of principal no matter how often you make your payments. Again, calculating the cost of interest, you have cost of open-ended credit, cost of credit, and expected inflation, and then avoiding the monthly minimum trap. So if we're talking about your cost of open-ended credit, creditors need to explain how they're going to calculate their finance charges. As far as inflation goes, obviously we know that inflation is going to reduce the buying power. And then avoiding the minimum trap, you don't want to just make the minimum payment when you get your statement. It typically gives you two options. It'll say if you pay this amount, it'll take you 3 years to pay off, or whatever the case may be. If you pay the minimum balance, it'll take you 30 years to pay off. So you could have a $2,000 credit or credit card. You have a balance of $2,000, and if you don't pay that off, if you pay the minimum all the time, it could take you 31 years to pay that off, depending on the APR. 5 C's of credit. You have character, capacity, capital, collateral, and credit history. And then talking about repaying the loan and your assets and your net worth. What happens if you don't repay the loan, and then what is your credit history like? Your equal credit opportunity, obviously lenders, they can't ask you about your age or whether you've had public assistance or housing. They can't discriminate against your race or your nationality, your age, your marital status, what gender you are. They take a look at your credit rating, which is a measure of a person's ability and willingness to make a credit payment on time. And there's factors that go into your credit rating, such as your income, how much money you make, your current debt, so what you owe people or creditors right now, your character information, and then if you've previously repaid any debts that you had. So what happens if your application is denied? You're entitled to know. You can contact the credit bureau for a copy of your report, and there's no fee for this if you do it within 60 days. And it'll help you correct anything that's inaccurate or get you more information as to how you can improve your credit rating. And then your credit report is a credit file of your credit history. It's maintained by the credit bureaus. They collect information on how people pay their bills. And there's 3 different credit unions that are reporting. So these are the bureaus and who your credit reports are coming from. And then what's in your credit file? You have your name, your employer, position, previous address, spouse information, your rent, whether you rent or own a home, how much credit you have, your social security number, your birth date, all of those things.